Yo, what is going on, guys? Ryan C here, the Lux Trader. And if you guys don't know, I spent the last decade of my life working at hedge funds, financial institutions, and making a whole lot of money in the markets. So if you guys are watching this in 2026 and you're serious about getting into the financial markets, then this video is meant to give you clarity, not just motivation. Because most people don't fail because they lack intelligence. They fail because they enter the markets with the wrong framework, the wrong expectations, and they choose an asset class that just doesn't work for them. It works against them from day one. So in this video, I'm going to walk you through the main financial markets available in 2026, explain how each one actually behaves, and then explain why after years of exposure and experience, I personally narrowed down my focus to Forex and gold mainly. Now, this video is not financial advice. This is perspective built from my own personal experiences. So what does getting into the financial markets even really mean? When people say, I want to trade, they don't usually realize what they're signing up for, because trading is not a single skill. It's a combination of risk management, execution, psychology, patience, market understanding, and honestly, in 2026, access to markets is easier than ever. But that also means that the competition is higher than ever. So the main asset classes today that are available to most retail traders are stocks, Forex, commodities, crypto, indices, bonds, and interest rate instruments. Now, each of these markets has different rules, different participants, different advantages, different disadvantages, and the biggest mistake that beginners make is assuming all markets behave the same. They don't. So let's get into stocks first. Stocks represent ownership in individual companies. This market feels comfortable because people recognize the names: Apple, Tesla, Nvidia, Microsoft. But familiarity does not equal simplicity in the slightest. In 2026, stock markets are heavily dominated by institutions like the one I worked in, by algorithms, by high-frequency traders and bots, and dark pool liquidity. And if you're day trading stocks, you're competing with the firms that have better data, faster execution, and way deeper pockets. Way deeper. For long-term investors, stocks make sense. For active traders with, small to medium capital, stocks can be very difficult because you need larger accounts to start managing that risk properly. You deal with gaps, earning risk, halts, and unpredictable news. And this is why many retail traders burn out in stocks before they ever even develop consistency. Crypto, on the other hand, is the market that attracts the most attention right now. Huge, very fast moves, big percentages, stories of people turning tiny $4 or $5 investments into $5 million. Yes, these opportunities exist. But crypto markets are very narrative driven and liquidity can vanish very, very fast. If you guys have been in any meme coins, you know this. Market structure can change overnight and regulation uncertainty is constant. You see, in crypto, technical analysis often works until sentiment flips. Then nothing matters. This doesn't make crypto useless. It just makes it unreliable, I would say, as a foundation for learning how markets truly function. I personally view crypto as a secondary opportunistic market, not a core training ground. Now, commodities, on the other hand, are tied to the real economy. Energy, metals, agricultural products, and these markets move based on supply, demand, geopolitics, inflation, interest rates, global growth, blah, blah, blah. Many commodities are difficult for retail traders due to volatility, contract specifications, and irregular price behavior. But there's one commodity that sets itself apart from everything else: gold. And if you guys were not living under a rock in 2025, then I think you guys know what gold did. We'll talk more about gold soon. Let's talk about Forex. Forex is the backbone of global finance. See, currencies are traded by banks, governments and corporations, hedge funds, central banks, and it is the largest and the most liquid market on planet Earth. And in 2026, Forex remains very structurally clean because price respects levels, liquidity in the market is consistent, very consistent. Trading sessions are predictable. There's only a couple trading sessions. We know when the volatility is going to happen. Hint, it's New York session. Forex is driven by interest rates, macroeconomic data, monetary policy, and capital flows. Now, what makes Forex so powerful for traders is its scalability. In Forex, you can start small. You can trade intraday or swing or scalp. You can use leverage responsibly. I don't want to see no 1000x leverage. You can use leverage responsibly. You can grow without changing your strategy. And Forex genuinely rewards structure. Patience, structure, execution, not excitement. Now, let's talk about the biggest one of them all, gold. simple. You see, gold deserves its own category. Gold sits between Forex and commodities, but it behaves uniquely. Gold reacts to, obviously, inflation expectations. Gold reacts to interest rates. Gold reacts to fear, to uncertainty, to liquidity conditions, to war, to political uncertainty. When money loses trusts, aka the dollar, when the dollar loses trust, gold absorbs it. And gold is one of the most psychologically driven markets to ever exist. Fear, greed, protection, speculation, all these different emotions, they show up clearly in gold's price action. And technically, gold is very clean. Fundamentally, gold is very logical. And emotionally, gold is very powerful. Honestly, guys, there's no better feeling than buying a gold bar and just keeping it in your house and just staring at it. At the end of the day, gold is gold. And this combination makes it one of the best markets to study and trade. So why did I personally choose Forex and gold? And my decision came down to three things: liquidity, repeatability, scalability. That's these three things. Forex and gold trade trillions, not millions, not billions, trillions daily. They do not depend on retail hype. They move because real money, big money, governments, move them. The same setups repeat across years and macro cycles. And most importantly, what works on, small accounts, on even $50, $100, $200 accounts, works on $500, $1 million, $2 million accounts. And that's not true for many markets. So how would I recommend a beginner to start in 2026? If you're starting from scratch in 2026, here is the most honest, most realistic path. Pick one market out of the four I mentioned, preferably Forex, one asset, one strategy, one time frame, and ignore the people trading everything. Ignore fast money content and start on a demo account. Then start trading small capital. Treat that demo account like a real account. Take very small trades. I don't want to see a demo account with $25 million and 300 lots on gold and you're making 25 million a second. You're playing a video game at that point. Start small, treat the demo account like it's a real account, and focus on, proper execution, not on profits. Your goal early on is not money. It's consistency, finding an edge, surviving, because the market's always going to be there. Your capital, though, will not be there if you rush. So getting into the financial market in 2026 is not about intelligence or talent. It's about discipline and selection. You choose structure over hype, you choose patience over excitement, and you choose mastery over shortcuts. The goal is not to trade more. The goal is to trade better. If you found value in this video, please subscribe. I break down the markets often with clarity, with not noise, and I'll see you guys in the next video. Peace. Take care.